Hello everybody, Stuart here again. Nectaris is not well today, so I've stepped in to take his 2019 outlook and our view of the year ahead. Obviously longer term charts, but sometimes these longer trends can persist, so it's worth having a look. And this is, I say, this is our own view of the next 12 months. So welcome everybody. Before we get going, usual situation, a bit of admin. So we're going to have some news, some charts based on the weekly timeframes, and some mute's been on. So there, can everybody hear me? I think I might have been talking to myself for a few seconds or a couple of minutes. So welcome everybody. Usual admin issue. It's all about the 2019 outlook. Right, Raj can hear me. Good. I think I'm not sure if you've heard me before that, but any issues, obviously, webinars at hotforex.com is our email. We'll get back to you as soon as we can. About anything. It doesn't necessarily have to be about 2019 and what the charts are telling us. This is based on weekly charts, so the higher time frames, but as I said, probably to myself now, because nobody was listening to me, these long trends can run, so it's worth bearing in mind, even as intraday traders, what some of these high time frames are doing and where these support and resistance levels may or may not be. So I say welcome everybody. Before we get going, I just need to read out this disclaimer here. So the material here is provided by a general marketing communication for information purposes and does not constitute independent investment research. Nothing in this communication contains or should be considered investment advice or a recommendation or a solicitation for the purpose of buying or selling of any financial instrument. All information provided is gathered from reputable sources, and any information containing an indication of past performance is not a guarantee or reliable indicator of future performance. Users acknowledge that any investment in Forex and CFD product is characterized by a certain degree of uncertainty, and that any investment of this nature involves a high level of risk for which the users are solely responsible and liable. We assume no liability for any loss arising from any investment made based on the information provided in this communication. And finally, this communication must not be reproduced or further distributed without further written permission. So I hope that all makes sense. And let's get going. So my background is in the City of London. I've worked for an investment bank and a retail bank. I've been investing myself since 1997, and my approach to trading and investment is all about probability, simplicity, looking at what the charts are telling me, looking at multiple time frames, but most importantly, knowing yourself. And that's a webinar all in its own. And watch our mindset webinar from last week for more on that. It's probably the most significant thing you can improve on or deal with. Anybody can learn to read charts or candle patterns or support and resistance levels, but only you really know yourself truly. So get that that box ticked, and you can certainly move forward in this business. So we're going to run through the 10 key assets. The dollar is king always, and what the dollar index is doing is a reflection of the mighty greenback. So last year it was in a very strong, well, it was very weak at the beginning of the year. Here we are, we went sideways and then had a very, very strong year right until the end of the year, running to the beginning of December. We had a strong dollar, and it's rolled over recently. Right, just one caveat on the dollar USD index. Remember, it's made up of six key currencies, and the biggest component of that currency is the euro. So the dollar euro rate has a bigger influence on this chart than most of the other cross currencies. So it includes things like the pound as well. The Swiss krone is in there as well. So it's 6 key currencies. It's a weighted index, and the euro of the 6 is the most significant weighting within that index to create the dollar index. So just remember, everybody be aware of that. So here we are. We had a weakish start, low down here under 90. At the beginning of 2018, looked like a weak dollar was ensue for the years. We were going down here, and this is what everybody was saying, including us, this year. In fact, we had a weakish first quarter, and you see here we got to the end of the first quarter, and the dollar just rallied. And I say it rallied right and through end of quarter one, quarter two, quarter three, most of quarter four, and it was only in these last few weeks of the year, as you can see here, where dollar started to give up some of its gains. So at the moment, it's back under this key moving average here. This is our 20-period simple moving average up here on the weekly chart. So at the moment, it's between its pivot point and support. So for me, it's really in a neutral basis. If I can just insert some pens, I think is what we're doing. So for here, we're between these two key levels here, this 97.50 level or 97.30 level and 94.25. So support 1, R1, and pivoting around to this 96 level. So this is very much in this sort of box at the moment. Okay, obviously we've been out of the box for some of the year, but this is where we are now. So break of these two levels is key for the dollar index, and generally we're technically neutral. These are the pivot points we've just talked about, and it's all to do with expectations, both political and economic, coming out of the Fed in particular. Tundi, link to download the video at the end. Yes, Tundi, there'll be you'll get an email to watch this again up on our YouTube and our past webinar site at the end of the link if you can't stay for the whole session. I completely understand that, but thank you for your time. So yeah, the expectation now is that the FOMC, the Fed, the Federal Open Market Committee, part of the Federal Central Bank in the US, are likely to technically at the moment they're still talking about 1 or 2 rate hikes for 2019. There's market participants and expectations possibly of 0 highlights. This pause that everybody's been talking about in the last few weeks it may go on, and so there's no rate hikes at all for 2019. So in our view, the FOMC likely to be more dovish as the year progresses, but more volatility could come back into markets, especially equity and bond markets during 2019 than we had in 2018. And 2018 was much more volatile than we'd had for the previous sort of 5, 6, 7, 8 years, really. So the equity rally continues. With question marks over has it come to an end. It's turned around again in the last few weeks, but we had a big sell-off into the end of the year, into certainly Christmas Eve was a big sell-off. We turned around on the 26th, but on low volume. So whether this recovery will be maintained is question mark. We're into obviously fourth quarter earnings starts in the next month or so, started now for the next month or so, next 2 or 3 weeks. So that's key, how the year has ended. But there's again talk with regard to equity markets that the earnings peak was in. As far as how that feeds through for the US dollar is, I mean, traditionally, strong economy, strong US dollar. So as the economy potentially weakens, the dollar is potentially weakening. If, as now is anticipated, there's less rate rises for 2019, and indeed, if there's no rate rises, the dollar will continue to sink on that. Obviously, the political risk in the US is obviously the unconventionality of the president. He does what he wants, he does what he thinks, he speaks his mind. Lots of people love that, but as far as planning and economic outlook is concerned, it's not great. But obviously his mandate has been reduced quite significantly in the fact that the House is now run by the Democrats, and that's what we're suffering now, or the market sentiment is suffering now. This shutdown of the US government has gone on for 25, 26 days. It will start to ripple through and start to have economic impact. The government itself reckons, the impact on GDP for the US for this year is 0.1, 0.13 to 0.15% for every 2 weeks that the shutdown goes on for. We're into third week now, and obviously that over the course of the year it may be insignificant, but it's it's an unnecessary drag on GDP growth. Also, the other issue with regard to political risk this year for the US is obviously the Mueller investigation into the well, officially it was all to do with the Russians messing with the US election in 2016, but obviously that has ramifications not just for President Trump personally, but President Trump, the businessman, as well as President Trump, obviously the president. But the ultimate, impeaching the president, trying to get rid of him, is very, very unlikely. The Democrats are very unlikely to actually try and push through with that, even if there's some stuff that sticks from the Mueller investigation actually on Trump himself, which he's denied it obviously completely. It's stuck on a lot of people very closely related to him over his period, but the actual principal investigation of the team was to look at Russian meddling, and that's not been proven yet. We'll see what comes out of that. So that's a key risk that's underlying sentiment. The other key risk is this the trade war, and we can officially call it a trade war now. There's lots of positive news currently about that, but my personal view is that this is going to drag on much longer than people anticipate. There's a significant slowdown in the Chinese economy. There's no doubt about that. GDP data from the Chinese economy is out next week. So watch that one as well. So that's obviously the political mandate being reduced in the US, and the economic pressure in China is bringing both parties closer to the table. The theory goes. So this trade war may come to some sort of conclusion, but I'm not as convinced as many that will happen. Again, this is on my own personal view. There was the 90-day truce was declared in November, and not a great deal, to be honest, has happened since then. And here we are in the middle of January. So we'll see how it goes, but that's another key risk. So we've got political risk, trade risk, and obviously the main driver of the dollar is interest rates in the US, and the rate hike is the projected rate hike, and they're likely to slow for 2019. So again, the theory is that the dollar appreciation will slow. We won't see that rise that we had last year. But obviously, the flip side of that is that no other central bank is really going to be any more hawkish in interest rates anyway. So the complete demise of the dollar, or the move down from the dollar of this area, is perhaps overblown, which is why I ended up in the neutral camp as far as the dollar index is concerned. Anyway, obviously, any questions that I'm saying things that you don't understand, if I'm speaking too quickly, please ask me to slow down. But there we go. As far as the dollar is concerned, as far as the euro is concerned, obviously we've last year in particular here we were up here at 125, 126 at one point against the dollar. And we, as the dollar's improved, as we've just said, from Q1 onwards, obviously euro-dollar rate fell quite significantly. So we ran all the way down to 112, under 113 during 2018. And it remains relatively sort of neutral is the wrong word, but it still remains relatively weak. We're under R1, we're just above the pivot here, so we've sort of fairly strong support here at this S1 level, but then S2 and S3 come all the way down to these 108 levels. Remember, we were all way down not that long ago, 18 months ago, beginning of 2017. sorry, 2 years ago at this 105, 104 levels as well for euro as well. So before the dollar weakened through that year, and then it's strengthened during 2018. So key support around this 112 area, 110. Sorry, this 112 area. So again, sounds a bit of a cop out, but a bit of a neutral stance on there. 114.30 is the pivot point, and again, it's what we're saying here. We've come down weak to the bias to the underside. We're just about crawling around this, literally scrolling around the pivot point at the moment with support down here. So no great deal to drive the euro up. Remember, the eurozone, they've already ECB have already said the main driver of the rate of the euro again is interest rates, and with interest rates not likely to move until the end of the third quarter into the fourth quarter, if they do at all. For 2019, that keeps the euro on the sidelines in the sense. Again, Brexit. I'll start with Brexit. It's obviously it has a massive impact. It's still scheduled to take place on the March the 29th, but obviously yesterday changed the ballpark a wee bit. Well, significantly, not more, a wee bit. But as far as the euro side of the argument's concerned. They're sitting there saying, well, we're the 27, you left as UK, so the impact is of the UK finding it more difficult to do trade with the eurozone, both for goods and for services, has an impact on certain sectors. So things like the German car manufacturers will be impacted quite significantly. The services business, a lot of it will remain in the UK instead of. And a lot of companies from the services sector have had to do is set up new offshore, no, not offshore, but new offices in the euro area to cope with this Brexit situation. So, but as far as the number of jobs is concerned, the amount of business that's actually leaving the UK, it's not as significant as first thought. So. It's more to do. The problem is much more to do, obviously, from the UK side and isn't from the euro area side. But obviously, that has an impact and a feed through. The political risk remains on the peripheral areas. Greece and Portugal. The situation in Italy as well cannot be undermined. We haven't actually put that in there, but that seems to be better. But it remains a big issue. The other key political issue is that the whole of the EU. Area becomes up for election in May, and if the extension of the Brexit deal goes as many are expecting now into June, that runs over that area. Obviously, the other key thing, what the EU elections will herald, will be perhaps a rise of the EU skeptic further. Whether they're left-wing parties or right-wing parties, it's just more pressure on the EU potentially, and that fills through to sentiment, which in turn filters through to the euro. So I say on the flip side, the positive side for the euro is this idea of a possible rate hike at the end of the third quarter, beginning of the fourth quarter this year. And obviously, as part of the EU elections as well, changes of people in seats is obviously the key thing, the key safe hands. I will do anything to support the euro. Mr. Draghi gives up the lead of the ECB towards the end of the year as well. So again, there'll be lots of manoeuvring both politically and by country as well about who replaces Mario Draghi, the Italian safe pair of hands for the ECB policy. Will be reflected by the new guy or new lady, but won't change dramatically, I imagine. So it's all a bit neutral really for euro because the interest rates, the main drivers, they're not going. They've already said that. But the risk is that the growth that's gone from glacial a year or so ago picked up a wee bit, but now we're slipping back. Not quite. The growth isn't glacial anymore. That absolutely. Just not happening, but it's moving forward a wee bit better than we were sort of 18 months ago. So unemployment's coming down. So things are definitely moving forward in the euro area, but perhaps not enough to look at a rate hike in the third, fourth quarter, but that's still potentially on the cards. Yen, again, a bit of a neutral one. That sounds all a bit boring, doesn't it? Neutral, but it's all to do with a weakening. It's a higher level weakening dollar. But again, last year we had some fairly strong moves. We were down at these 105, 104 levels again, down here at the beginning of the year. And it looked like dollar was going to fall further, but big turnaround, I say. So we had seen the same picture. We ran all the way to 115, but we can't get over this 114.50 level, which we've, big psychological level for the last 18 months or so. So, and then it bounced off, and it bounced off very aggressively. So as the other two we just looked at, the index and the euro moved down quite slowly in the end of December. The yen has had a really quite significant strong bid, and then we had this a spike on the bid on the yen over the 2nd and 3rd of January. Unsurprisingly, when it spiked to its a low that had previously been hit, and so it was literally only minutes, this spike, but that's still affecting these levels, and it will still be a level that will come into play at one point. Just like this level here, when we were back up here, think, well, that's miles away. That's never going to be. When's that going to be tested again? Well, markets have a very strange way of going back to these levels time and time again, and that's a great example of seemed a long way, even when we were here, that into the end of the year, that still seemed an awful long way away. But within a week, that level down here, 104, had been tested. So it's not to be discounted, although it's obviously an extreme spike. But there remain, that's a very strong move down on those weekly charts. Those 2-3 weeks, very strong bid for yen and a weakening dollar. So we got a double whammy there. We got a weakening dollar and a double whammy for the rise in geopolitical tension. So there's a bid for the yen as geopolitical tensions rise, and also the safe haven bid comes in for the dollar yen. Nedson, you've put ECB. I don't know quite sure what you mean. ECB. What do you mean? Was that from the previous slide? I'm not sure. I've just noticed your question, but European Central Bank, Nedson, is the ECB. That's what your question was. Anyway, let's keep going. So pivot point 111.25 for the yen. Technically remains bearish over the last 4 weeks, and as you've just seen on that chart, very weak down. As far as the Japanese economy is concerned, it's probably potentially it's been grinding up a bit faster than euro area, but the economic outlooks, it's always very tentative. Every year you look at Japan and think, well, is it, this is going to be going on for 25-30 years, it's grinding growth, but outlook a bit better than last year, but still fragile is our thoughts. The carry trade, the difference between the interest rate differentials, remember the Bank of Japan and Abenomics down here, it's not it's going to remain accommodative, as we put down here. So negative interest rates are still the likely outcome for the end of 2019, or back to zero at the very most. So interest rate expected to remain negative because inflation is the key target for the Bank of Japan, and it keeps getting kicked down the road. This 2% inflation expectation. It's been it's a nirvana as far as the Japanese economy is concerned. It's a long way away. So pressure remains to the downside in our view, and so dollar yen remains bearish technically, but also fundamentally this big strong top here, and where we're all 108 and 106, and then could test this low again. But the move down has obviously been very aggressive, which is typical. We move up slowly, move down very aggressively, so we could find some support at this current level, 108, 106 zone for now over the first quarter certainly. So that's yen. Sanjeev, provide me the support resistance tool you're using on your charts, or send me the link from where you can download this tool. Okay, Sanjeev. Let me just show you. It's nothing. You know, they're no, not everywhere, but can I bring that in? Let me just bring in my charts and let it show you. So this a few people ask about this. People asking yesterday about it. So the support, this isn't actually on here, but this is I don't know what charts this is. I don't know. Let's bring up a chart. It doesn't have to be any old chart. So I was trying to find a. Right, so this is the Chinese dollar against the Chinese. So it hasn't got support and resistance on. So how do we put support and resistance on? So here you simply click the navigator tool, and we have these hot Forex indicators that you can put on. If you haven't got, when you click on your navigator tool, Control N, you don't see these extra assets or these extra tools. The hot Forex ones here under the expert advisor from the premium trading tool, or these ones here, which you know anything that says hot Forex. What you need to do is go to our website and make sure that you've got the right version of the MT4 platform. And to do that, what you need to do, so if we go to, so we just got that. Can you actually see? I can't actually see what you're saying. Let me just check you can see all that. Right, okay, so let's go to our homepage. So what you need is a product called sorry, it's on the tools. I'm talking about product. So it's a tool called a Premium Trader Tools. Okay, so if you click on Sanjeev and everybody else, you click on Premium Trader Tools, and you download this package. I think you need $500 or $200 in your account to activate it. I can't remember what it is. If you download this package, Premium Trader Tools, which have got lots of little indicators in them as well as the ones you've just seen, the pivot point ones, that will then bring up these extra items in your navigator tool. Okay, so let me just say that again. If you haven't got these extra ones, go to our website, go to the tools tab, and you want to download the Premium Trader Tools. Okay, you come up with this, load this, and then you will restart your MT4 platform, and you will get these extra indicators. And we've done webinars on some of these other things like Dogshian, the Gravity, and Keltner and stuff. So we'll do some more on those. But the one you want, Sanjeev, is this one here, pivot point. Okay, so you simply indicate what you want. Now the default standard is to look at the daily time frame, but obviously you can change that. So actually, let's just leave it as default for now. But obviously, on the ones what charts we're looking at the moment, the weekly ones, you change this to a monthly view, weekly view. Depends on how you want to view it. But the default is the daily time frame, because that's what you do is when you trade. We're actually trading live intraday and or even on the intraday charts. And then you can also change the how many bars it counts. You take it back to 3 and 1, and I'll show you some of when you change this, it obviously gives a variance, but again, it's defaulted to just one standard. So simply, and then you can change the colors as well that you want. Make sure both these boxes here are clicked DLL imports. Okay, so you can fiddle with these if you want to. Change the colors, change the way the lines look across the chart, have them right across this show lines all the way across the chart, or yes, you need to have that yes or no, so the lines go right across. I don't want them on there. Default is not to have them all the way over. So again, so that's okay. So, and now here you see on this one, let's just get rid of that. So here, pivot point, Sanjay, I hope that's answered your question. And there we go. You can see it now. Let's just fill that up. Now you can see it's now put in the resistance and the support levels for the dollar against the Chinese yuan. So interestingly, we're right on the pivot point in the moment. So simple as that. That's all, and that's all those charts are showing. Okay, so I'll answer your question, Sanjeev. So where were we? Yeah, dollar yen bearish for the year, or going forward into the going forward. As I say, interest rate differential add to that pressure. Economic outlook better in the no problem, Sanjeev, in Japan, but still not great, and it's all about in negative interest rates and the view of Abenomics. Now then, the currency of the moment, the pound. Remains, as it's against the dollar. So the dollar had a good, weak first quarter, strong 2, 3, and 4, 2, 3, and most of 4, and then we turned around here. But the thing is, dogging the pound all the time, and has been since where we are even obviously off this chart, has been the uncertainty over Brexit. So although the pound rallied here during 2017 immediately after. Because of the weakening dollar, that soon turned around. So these levels we were at down here back in the beginning of 2017, these 120 levels and even lower 115, 116 levels could easily be tested again if the Brexit is a mess and if there's a no deal. What's happened now, and just bring you bang up to date, what's happened last night is that the chances now of a no deal have shrunk quite significantly. So the pressure to the upside is probably much greater now for cable significantly. So this even this R3 level up here at 140 could easily be tested. And remember, we were up at 143, 145. We got within a smidge of last year. That could be easily tested. But obviously, when we put this chart together, the technical pressure was still to the downside, and that still maintains at the moment. It hasn't broken this 20 period. We're just right on the pivot point last week when we put these charts together for the end of 2018, and so pressure still remains to the downside. That downtrend hasn't moved. It's all about it's all about Brexit, and that's the thing that's driving obviously the pound, and more importantly, the real Brexit trade pair is obviously the pound euro, not necessarily cable, because obviously, as I say, expectations are that the Fed will slow down, and the Bank of England might actually have to act as the Brexit clarification is clarified. So the theory was that Bank of England may move interest rates up another quarter of 1%, 25 basis points, as early as May after the Brexit situation, the 29th of March is triggered, but obviously that's now potentially under a question with this massive loss that Mrs. May suffered yesterday. So technically it's just about turned bullish. We've got this pivot at 33.50, 33.62, and these resistance levels may come maybe quite hang on a minute, those numbers look wrong. Is that the right one? No, that's those numbers. This is the wrong numbers on here. Ignore these numbers. Sorry about that. Where are we? No, the pivot area is here, 128.50. For some reason that must be from last year. Those words are correct, but this chart, these numbers here are wrong, so ignore that. So let's just go back to this. Let me just review this. So the pivot is here is 128.50 or 128.25. The first resistance is 131 or 132 area, 136, and then 140. Really, that's those should say. So let me just. Oops. So really, this is this should be 128, and this is resistance that's 140, not necessarily 142, but 138 area, and this is 136 area. Okay, so sorry about that. That chart's wrong. That slide's wrong. But look at the chart rather than the slide. Okay, so you can see support is down here at 124, 123 technically there, and then 120, 50, and then 116 down to the downside. But it looks like a potentially bullish cable rate, and many are positioning for such a situation. Okay, so ignore that one. So yeah, it's really all about Brexit again. You know, as I say, the hard Brexit and general election have both faded. So it looks like there will be a softer Brexit and an extension of the March 29th date. Although that's not given, an extension of the deadline if there's some new law. There would need a new law in the UK to be passed that. So and then chance of a second referendum, like a general election. Chance of a second referendum, just might say, oh, come on, let's take it back to the people. That may have increased as well, so possibly up to 25%. And I say Bank of England likely to act once this Brexit situation has clarified itself. But all of the uncertainty has weakened the UK economy. It's the weakest grower of the G7 countries. Wages are starting to tick up because there's a pressure on labour, because there's literally workers are leaving the country because of the Brexit situation, and it's to do with that as much as obviously a skill shortage as well. But so that might actually add to inflation, even though inflation is really benign, but it's the wages are finally ticking up, but productivity hasn't increased. So it's not great in the UK at the moment. Gold remains very bullish. We had this big move down. We ran to 1350, 1365 during 2018. We had this big move down from April down to the low here in August of 1160, and then we've turned around quite significantly, and we're now over the key 1250 level, and that looks very bullish here on this weekly chart. So next resistance is 1315, 1350, the top, and then even next on this weekly chart, resistance is up at over 1400 for gold. To the downside, support slips under the low, so it needs to close below the low of August is 1160 down to 1150, and then 1115, and then back to 1100 for gold. But gold, I say bullish. First quarter is quite important for gold price for the rest of the year. Just rattle through these numbers. A weakening dollar would obviously help the demand for safe havens, and gold being the key safe haven. This idea of the inverted yield curve, where the long-term rates on government bonds are lower than short-term rates, with it, every time that's happened, the 10-year going under the 2-year, every time that's happened, we've had a recession within certainly 18 months to 2 years. That adds to the negativity in the markets, and that would add to the gold bid, as well as any increasing geopolitical tension. So, any cranking up of current stable relations with North Korea, that could slip back the other way. Iran is the other one as far as the US are concerned, and obviously the whole situation in the other part of the Middle East as well, around Saudi and Yemen, and the fallout with Qatar, and all that sort of tension in the Middle East. And obviously this situation in Syria is awful, but again brings in the Russian-US relationship, and the whole geopolitical situation becomes a big melting pot. And therefore, as that increases, investors look for safe havens. Safe haven asset is gold, and is the dollar, as is the dollar to an extent, but much more so the Japanese yen and the Swiss franc. So gold, fundamentally, sentiment-wise, is okay, and relatively well bid technically as well. What is this Brexit all about? Please brief me. It's been going on for 2 years. Basically, Brexit in a nutshell is Brexit means the British leaving the EU. So the UK has been part of the European Union, both a political and economic union area, for longer than that. And the British 2 years ago, in June 2016, voted to leave, and stuff that's been political ties and trading ties that have been bound together for 44 years are very difficult to break very easily. And so the whole issue of how Britain taking its own sovereignty back, taking its laws back, taking control of its borders back, all of those sort of things were done centrally through Brussels, and the Brits have voted to take all that back. They've always kept their independent currency. They never went with the euro area, so that's the issue. The downside is obviously travel becomes more difficult. Immigration, they say they can control their own borders, but people can't. Then there's no freedom of movement of people and goods and resources, which was all part of the common EU approach. All that's gone back basically. So that's Brexit in a nutshell, and very political hot potato. Oil, big, we ran up to our target from last year of $76, and it turned around very, very aggressively. So just like, I can't remember what chart we were looking at before, but just like trends go up slowly, they come down quickly, and that's exactly what we've had since the beginning of October, wasn't it? Was this high? Was it November? November it was, yeah. So we've come down 1, 2, what's that, 1, 2, 14 weeks down now, so big move down. So under the psychological, 55 now is really the key pivot for US oil. This is US oil, not Brent, WTI, West Texas Intermediate, that stands for. Resistance at around 67.50. The latest top from last year was a key level we need to watch at as well, at $76, and then as high as $89 R2 on this pivot point. Support drops all the way down here to 33. So what first we need to break this low here at 42, which we touched in the move down. We talked about, again, that looked like a big short position on oil, weren't we? We tested this 42. So again, that's props first resistance level or first support level, then 33, and then it's low as $21. So outlook for oil remains relatively bearish. If we fiddle with the, we go take this further back to a few years back, 2014, you can see how R3 takes us here to $100. Likely of $100 next year is very, very, very remote. But this actually S2, as you can see here, takes us down to $21. So again, that's very, very remote, but never say never, and that's why these levels are there. Big option spreads on oil. So technically remains bearish. We need to break this 55 and hold 50. Sorry, we need to hold 50 and get over 55 if we're going to move up to this 67, then 78, and then 89 potentially. But support, I say 42, 33, 21. So a wide spread on oil. All to do with the slowing global growth. If China does slow significantly, it was big consumer of oil. Production has always been the price of oil has been undermined by the production being so high out of OPEC, and obviously the US area as well as Russia as well, OPEC plus as they call it. So a slowdown in global growth, not a cut in production, which the Saudis announced just a few weeks ago. On top of the cut that was agreed in December, but it's not real. There's still lots and lots of oil sloshing about. So we've recovered $50 a barrel, but whether we get above 55 is the next big stumbling point, and then into 68. But obviously, it's caveat. Oil is a big resource. It's used for lots of things other than fossil fuels, things like pharmaceuticals and chemicals and what have you. But as the world, as the automotive, the world moves to a less fossil fuel dependent world, oil in the long time and its derivatives, it's a long term decline. So I know it's not going to suddenly happen this year, but just bear that in mind. The oil producers need to be looking for other customers for their oil rather than just simply burning petroleum and diesel and jet fuel and what have you. I mean, it's obviously not going to come to an end immediately, but the long-term demand is perhaps in decline as we move to a greener environment. Otherwise, future's not great. Bitcoin, where are we? Quarter 2. So yeah, Bitcoin and commodity currencies to do. So Bitcoin, stellar year, obviously crazy year, 2017. Big movement down, also 2018. We've given up 75% of this massive rise to 19,000. So volatile up, volatile down, big volumes as well this year. We held you can't quite see it on here, but the key level was really the 6,000 level for most of the year. But when that broke, and on big volume, it broke very significantly, and we crashed into 3,000. So technically, just looking at the chart, you can see we've consolidated and then broken lower. So we've broken out and we've broken down. Where's the next support? Well, S1 is here at 2,300, and S2 up on these weekly charts is down here at 700, and S3 takes it all the way down to 150. So the pressure to the downside remains. We're way under the 20 period moving average here technically. Pivot point is at 4,800. So key resistance is 6,300 now, above that key 6,000 support level. So it needs to get back into this channel here, Bitcoin, if it's going to move up. And then we got resistance back up here at 9,800 and 10,000, but they seem a long way away as far as Bitcoin's concerned. Obviously, we had the split. We've still got the security issues regarding cryptos. We've got EFT problems. So here's where we talk. So technically bearish cryptos on all of Bitcoin and all the cryptos generally. As say here, a roller coaster ride is from our report, which we are publishing in the next few days. So all this, what we've talked about today, is written down much more succinctly than me rabbling on about it. But we've got our report, our outlook for 2019 about to come out. So up and down, opportunities and risks as ever with volatile assets. Let's say one of its key benefits was no correlation to other assets, but the fundamental news is drivers. So again, it remains the US and the regulators with regards to the future of Bitcoin, and also the EFTs as well. They got rejected. Many got rejected, were never taken on. We have a futures market now, but it really hasn't taken off. There's thin volumes in there. But a weaker dollar may see these alternative assets see a bit of a bid, but we'll see how much the weaker dollar story may have been overplayed. So we could just instead of the growth we've had, it's just a grinding slowly moving down. So volatility continues, props to increase as with cryptos. Very difficult to tell, simply because it's such an emotional and sentiment-driven asset, all cryptos, and particularly Bitcoin. The commodity currencies, the Aussie remains relatively weak. Key level for me for the Aussie dollar is 72. We're sort of about there now, but first resistance comes in at 72.80, and then 75, and then 76.80. So again, the Aussie's weakened as the US dollar's increased, and questions over Chinese growth hangs on the Aussie dollar as well. Say the spike we had down, so that remains relatively weak. Again, this is just taken straight from our report. I won't read all of this out, but it could be a key year for the Australian dollar and Australian economy. Remember, the Aussie economy never went into slowdown or recession like others did after the crisis of 2008. But debt is an issue. The housing issue seems to have cooled down a wee bit, but it still won't go away. So it depends what the RBA do in tandem, perhaps with the Fed as well. But we'll see. And so there could be this is a very extended scenario, banking crisis, as the housing bubble bursts, because it hasn't slowed down sufficiently, many are saying. And then if we reduce exports, remember the Australian economy is very dependent, not very dependent, but many of its assets, I think something like 38% of its exports go to China. So if the slowing down in China does take a pace, we talked about this many years before, the hard landing in China. It's not happened, but it's looking a bit more significant this year at the moment. But the Chinese are acting very quickly, and they can act very quickly because it's such a controlled economy. So they've been pumping lots of stimulus into the Chinese economy to try and slow this slowdown down, if that makes sense. And I forgot what I was going to say there about Chinese economy. It's gone completely out of my head, as it does, but never mind. Anyway, so very much commodity driven, the Aussie economy. So commodity prices, Chinese economy, very, very key to the future of the Australian dollar. And as I say, watch key level is 72 for me, and then 72.50, and then the 75 level for the Aussie dollar. CAD, similar sort of move. Weakened throughout 2018 against the dollar strength rather than CAD weakness, to be honest. Oil price falling obviously doesn't help the CAD, but here dollar CAD missed this peak from 18 months ago, 2017, this 136.35 level when it's turned around. But just like the other currencies, the dollar hasn't given up the CAD move down very like it did against the like we've seen against the euro and the pound, and much more so against the yen. It's only the last couple of weeks that dollar CAD has turned down, but it still remains relatively bullish. It's over its 20-day moving average, 132, pivot at 133.50, stretched significantly, and the initial support through here at 128, and then 124.75 S2 for CAD. And again, if you take this back a bit further, because of the I thought I had another CAD chart. No, it's not. It's New Zealand. Anyway, again, this is a couple of paragraphs or 3 paragraphs taken out of our 2019. So you can download this as a PDF in the next few days. Steady old rate, great for 2018. Again, housing was the key issue. Exports, as a lot of it goes to the US. 74% of Canadian exports to the US. So as US has grown, that's helped the Canadian economy. But again, housing is a bit of a bubble, and there seems to be a decline in investment and housing and non-residential investment as well. So obviously the big issue from last year was this renegotiating of NAFTA. The Canadians, they stuck their heels in for a while, but we got the replacement after the USMCA. But the key thing, remember, both particularly from a political point of view, as far as the Americans are concerned, rather than the Canadians, to be honest, is the fact that it's not been ratified by the US Senate. And because we've had this change in the composition of the House and the House, not the Senate, sorry, the whole of the White House, the whole of the American Parliament, there's still a bit of question marks over that, although the chance of it not being ratified are actually quite low, but it's still, it still needs to happen. So anyway, you can see that. So if oil prices continue to decline, there could be continued decline on the Canadian dollar potentially as well. But we'll see. There's some quite positive growth in the Canadian economy, and the Bank of Canada are not avert to moving, and not necessarily sinking it. So this was the Kiwi. Had had a strong run, the Kiwi, but again came down most of the year, but turned around quite significantly, much earlier than others, and it's had a very, very strong run, the Kiwi dollar, from about the middle of October against most of its assets, and it's ran to 69.80 is that key level there for the New Zealand against the US dollar. So relatively well bid, and it holds over its 20 period here. So pivot is here at 67 is the key for the New Zealand dollar going forward. Remember, New Zealand dollar also very commodity driven, except it's soft commodities, not hard commodities like the Australian. Also exposure to China, lots of exports there. So particularly things like milk powder and agricultural products. So a key economy for small, 4 million people, but Kiwi dollar, very key for the carry trade, higher interest rates than anywhere else. And so you can see relatively well bid, and this is a different with different indicators on it, which we still got this 60, 69, 70 is a key level, and 67 remains the key pivot level for the New Zealand against the US dollar. So the other thing, although they've got higher interest rates, they've predicted, into 2020, the RBNZ, no interest rate rise, remain the same. Housing has become again a bit of a bubble. They've stopped foreign residents buying New Zealand property. So that may cool a bit. There's no key political events expected next year for New Zealand and the Kiwi, but as I said at the beginning there, the key risks really are the situation in China, which is likely to cool, Australia likely to cool on the back of China cooling, and commodity prices, whether they slip or general commodity prices, not necessarily the oil and the gold bonds we talk about, but commodity prices are key for the New Zealand economy. Lionel, I'm not going to talk about the dollar rand in particular here. It's I'll just say a general comment about the emerging market currencies. Generally, as if we do have a slipping, let's just go back to the dollar index. If we do see a slipping of the dollar this year, the benefit could be where are we? Right at the beginning, wasn't it? The benefit, although I'm saying here not a big slide. I'm neutral on the dollar. Why isn't that? Oops. I'm neutral on the dollar. It's stuck in this sort of range here between 97.3 and 94.26. Any decline which we've had here, I don't know if you're on the Facebook broadcast we did this morning, but any decline we've had in the dollar here will benefit the emerging market currencies, particularly the rand, the Turkish lira, and the Brazilian real as well, and obviously the ruble's more dependent on the oil price, but rand, Turkish lira, and the Chinese yuan, key emerging market currencies. And if this trend here continues, it may not, because we're going to the bottom of the support here. So we need to break the weakening dollar. It would be weak if we broke out of this level here, 93.73 level, this level here, 93.75. We could see an appreciation in the emerging market currencies as well. But obviously, there's particular issues with particular countries as well, whether it's to do with political and economic situation. Obviously, the issue in South Africa was the slippage into a recession or negative growth for 2 quarters of last year as well. So see if that turns around. But anyway, I haven't got any rand on a slide here, Lionel, I'm afraid. So that's all really. That's our view. It's a long term. Just to bear. Sometimes I stick these higher time frame resistance and support levels on even on my daily time frames when trading. So is there any questions at all about anything at all other than Lionel wanting to have a look at the rand? If not, we'll call it a day where our hours up. Just remember that tomorrow it's all about a technical indicator, volume weighted analysis, a volume weighted moving average, I should say. Live analysis is every Tuesday. Trading plan is absolutely vital. Nexaris will be back hopefully next week to run through that with you. Just wanting to make money is not good enough. You need a plan. Why are you doing this? What's the idea? Bollinger Bands also next week. Week after next, Andrea will have a more in-depth analysis of Bitcoin and the cryptos in general. Where we go for 2019? Will we continue to sink to under $1,000 for Bitcoin, or will it recover from this level and back to 6,000 and 10,000? Who knows? But Andrea will have her view at the end of the month, and then a final webinar for January is all about emotional control, managing that mindset. So join Otto for that one. My books, I say this all the time, key books, the best book in my view written on trading is this one here, the Reminiscences of a Stock Operator by Edwin Lever, about the story of Jesse Livermore. Most traders suffer with psychology in their mindset, and the key one for me is here, Trading in the Zone by Mark Douglas. Get it simply. Follow the quiz questionnaire and read the book. It will open your eyes very, very significantly. Jack Schwager is a great author on what's going on in the markets. This is all about a series of books called the Market Wizards series. Talks to hedge fund managers. He's got hedge fund Market Wizard book. He's got the original Market Wizards. He's got this one that he wrote 10 years later. Conversation with America's top traders, and they really are. These are billionaire guys. Started with, some of them are on literally $10 or a few $1,000, and they're, not only hedge fund managers run their own portfolios,